Hey everyone, welcome back for another deep dive with us.
Always a pleasure to be here.
This time we're going to get into something that I know can be a little scary for people, but we're going to make it fun and interesting. Taxes.
Taxes. Fun. I like the sound of that.
We're going to be looking at an article from AARP called Don't Fall for These Common Tax Myths. It's packed with really practical information, and hopefully by the end of this, you'll feel way more confident about your own taxes.
That's the goal. Knowledge is power, especially when it comes to finances.
Now, before we get too far, I do want to mention that everyone's tax situation is different.
Absolutely. What works for one person might not be right for another.
Exactly. So while we'll be covering some general principles today, it's crucial to get personalized advice from a qualified expert.
Could not agree more.
And that's where someone like John White, president of Financial Guideposts, can really make a difference.
He really is fantastic.
He's helped countless people navigate the complexities of the tax system and develop strategies that are tailored to their specific needs.
It's amazing to see the peace of mind people get when they have that kind of expert support.
So true. All right, let's dive into some of these myths. The first one that caught my eye is your income is taxed at one rate. This makes it sound like once you hit a certain income level, bam, all your earnings get taxed higher.
Yeah, I've heard that one before. It's definitely misleading.
Right. But that's not how it works at all, thanks to something called graduated tax brackets.
Graduated tax brackets, yeah. It's not a sudden jump like people imagine. It's more of a step-by-step process.
Okay, so explain it to us like we're 5 years old.
All right, imagine a staircase. Each step represents a different tax bracket. As you earn more income, you climb higher on the staircase, and each step has a different tax rate. But here's the key. Only the portion of your income that falls within each step or bracket is taxed at that rate.
Okay, that makes sense. So it's not like my entire income is suddenly taxed at a higher rate if I get a raise that pushes me into a new bracket.
Exactly. Only the amount that exceeds the threshold for that new bracket is taxed at the higher rate.
That's good to know. It's less scary than I thought. But it still makes planning important, right?
Yo, absolutely. Understanding how these brackets work can impact decisions about things like retirement contributions.
How so?
Well, if you contribute more to a 401k, for example, that lowers your taxable income, potentially keeping you in a lower tax bracket.
Smart move. It's like a little puzzle you can solve to your advantage.
That's a great way to put it. And someone like John White can be your puzzle master, helping you figure out the best strategies.
Right, he can help you analyze those trade-offs and really optimize your approach.
Okay, moving on to myth number 2, which I think a lot of people fall for, especially as we start thinking about retirement. You'll be in a lower tax bracket in retirement. It seems logical. You're not working full time, so less income, right?
Well, not so fast. It can be more complicated than that.
In what way?
Well, retirement income can come from a variety of sources.
Yeah.
Pensions, Social Security, 401k withdrawals, even part-time work if you choose to do that.
Ah, I see. It all adds up. Right, and those sources can combine to push you into a higher tax bracket than you might expect.
That makes sense. Plus, certain retirement decisions themselves have tax implications too.
Exactly. Think about something like converting a traditional IRA to a Roth IRA.
Right, which can be a really smart move for long-term growth, but there's that potential for a tax hit in the year of the conversion.
Precisely. It's a balancing act.
And that's where John White's expertise really comes in.
Absolutely. He can help you analyze those pros and cons.
He can help you figure out if a Roth conversion is right for you, what the potential tax impact would be, and how it all fits into your overall retirement plan.
Yeah, he's a master at breaking down those complex decisions into manageable steps.
So the takeaway here is, don't just assume retirement automatically means lower taxes.
Right. Get the facts specific to your situation.
Now, this next myth seems to trip people up every year.
Oh.
It's the idea that filing an extension means you can delay paying taxes. Sounds great on the surface, but is it really that simple?
It's a common misconception, that's for sure.
So, what's the truth?
The truth is that an extension only gives you more time to file the paperwork. It doesn't change how much you actually owe.
Ah, so your tax liability stays the same.
Exactly. And those taxes are generally due on April 15th, whether you file an extension or not.
So, if you know you're going to owe and just need a little more time to gather all your documents, by all means, file for an extension.
Yes, but pay what you owe on time to avoid those nasty penalties.
Because those penalties can really add up.
Oh, they can be significant. John White always emphasizes this to his clients, making sure they understand the importance of timely payments.
Right. He's all about helping people avoid those unnecessary costs.
He'd rather see that money go towards their goals, not to the IRS and penalties.
Okay, this next myth is for anyone out there who's selling things online or doing any kind of side gig. You don't need to report income if you didn't get a 1099-K. So you're crafting on Etsy, driving for a ride-sharing app, or maybe freelancing,
It's tempting to think that if you don't get that official form, the income just disappears, right?
right? Out of sight, out of mind.
Unfortunately, it doesn't work that way.
The IRS is always watching.
Pretty much. That 1099-K is just a tracking tool. It's not what determines whether you owe taxes.
And the threshold for getting a 1099-K is actually pretty high, isn't it?
It is. For 2024, it's $5,000 in gross payments. So you might be selling a few things here and there, well below that threshold, and think you're in the clear. But come tax time.
The IRS expects you to account for every dollar.
Exactly. Honesty and accuracy are key.
And I can imagine this is an area where someone like John White can provide a lot of valuable peace of mind.
Oh, absolutely. He knows all the ins and outs of self-employment income and the gig economy.
He can make sure his clients are compliant with the rules while also maximizing their deductions.
Exactly. It's not just about what you owe, it's about what you can rightfully reduce.
That's such a good point. It's not about trying to cheat the system. It's about understanding the rules and using them to your advantage legally and ethically.
Right on. Transparency is always the best policy when it comes to dealing with the IRS.
Speaking of transparency, let's talk about another myth that can catch people off guard, especially those who are freelancers or independent contractors. You can pay all your estimated taxes at the end of the year. The temptation to procrastinate is strong.
Oh, I know it. But the IRS has different plans.
They do, don't they?
They generally expect people with inconsistent income streams, like freelancers, to pay taxes throughout the year.
Yeah, those quarterly payments.
Right. It helps them maintain a steady flow of revenue, and it can actually help you avoid a big tax bill all at once.
That makes sense. So what happens if you don't make those quarterly payments?
Well, that's when those penalties we talked about earlier can come into play.
Yikes. No one wants that.
John White often uses this analogy to explain it to his clients. Imagine your taxes as rent.
Okay, I'm listening.
You wouldn't wait until the end of the year to pay a whole year's rent all at once, would you?
No, that would be a lot to handle all at once.
Exactly. Making those regular payments throughout the year, just like you would with rent, can save you a lot of stress and potential late fees down the road.
Love that analogy. It really
Right.
put things into perspective. Okay, let's move on to a myth that I think causes a lot of unnecessary anxiety. Only wealthy people get audited.
I think everyone's had that nightmare at some point.
Right. But is it really a rich person problem?
The truth is that audits are often triggered by errors or inconsistencies on your tax return, not necessarily your income level.
So math mistakes, claiming credits you don't qualify for, or failing to report all of your income, those are red flags no matter how much you earn.
Exactly. While the overall chances of getting audited are relatively low, it's still smart to be prepared.
Like the Boy Scouts say, be prepared.
John White has a great saying for this. The best way to avoid an audit is to be prepared for one.
Words to live by.
He helps his clients organize their records meticulously and make sure their returns are accurate and complete so they can face an audit with confidence if it ever happens.
That peace of mind is priceless. Okay, let's talk about a topic that can be emotionally charged and often confusing: inheritance. There's this myth that inheritance is always taxed. We've all heard those stories about huge inheritance taxes, but is it really that straightforward?
It's definitely not as simple as it sounds.
So break it down for us.
Well, first, you need to understand the difference between estate tax and inheritance tax.
Okay, estate tax versus inheritance tax, what's the difference?
Estate tax is paid by the estate itself before the assets are distributed to the heirs. Inheritance tax is paid by the person who inherits the assets, and not everyone who inherits something has to pay taxes on it.
So for example, if I inherit my grandmother's antique teapot collection, I'm probably not going to get hit with a big tax bill.
Probably not. And the threshold for federal estate tax is pretty high.
How high are we talking?
For 2024, it's $13.61 million. So unless you're dealing with a massive fortune, federal estate tax is unlikely to be an issue.
Okay, so it's really geared towards those larger estates.
Exactly. Plus, only a handful of states have their own estate or inheritance taxes.
So it's not as widespread as people might think.
Right. But even with those thresholds, inheritance can still be a complex process, especially when you're dealing with different types of assets.
Yeah, like property or investments.
Exactly. That's where someone like John White can be invaluable. He can guide you through the intricacies of inherited assets, help you understand any potential tax implications, and make informed decisions about managing those assets.
Right, because it can feel really overwhelming, especially when you're also dealing with the emotional side of losing a loved one.
Absolutely. Having that expert support can make all the difference.
Okay, now we're getting to a myth that I think a lot of people get wrong, and it's about something that feels really good. A big tax refund is a good thing. It's like getting a bonus check from the government, right?
It feels that way, doesn't it? But it's not quite the windfall it might seem.
So what's the reality?
A large tax refund really means you've overpaid your taxes throughout the year. You've essentially given the government an interest-free loan.
I see. So it's my own money coming back to me. It's not extra money.
Exactly. You're better off adjusting your withholdings or estimated payments so you keep more of your money throughout the year.
So you have access to it, you can invest it or use it for other things.
Right. You can put that money to work for you rather than letting the government hold on to it.
John White often uses a great analogy for this. He asks his clients, would you rather have access to your funds all year long or let someone else hold on to them for free?
It's a powerful way to frame it.
It really is. It's about being financially savvy and maximizing your resources. Okay, here's a myth that might appeal to our lazier side. Your tax preparer is liable for mistakes on your return. So if they mess up, it's on them.
Right. I wish. Unfortunately, that's not the case.
So who's ultimately responsible?
You are. The taxpayer is always ultimately responsible for the accuracy of their tax return.
So even if you hire a professional, you can't just blindly trust them.
Right. You need to review everything carefully, make sure it's all correct, and sign it before filing.
It's about being an active participant in the process.
Exactly. And when you're choosing a tax preparer, it's crucial to do your due diligence.
What should people look for?
Look for someone with experience, qualifications, and a good track record. Don't be afraid to ask questions about their process and how they handle client information.
It's a big decision. You're trusting them with sensitive financial data.
Exactly. Choose wisely.
Speaking of things to be wary of, let's wrap up this part of our tax myth deep dive with one that scammers love to exploit. The IRS will call you if there's a problem. It sounds official, right?
It does, but it's a classic scare tactic.
Yeah, so how does the IRS actually communicate with people?
Through official mail correspondence.
So if someone claiming to be from the IRS calls you demanding immediate payment or asking for personal information,
Red flag.
hang up.
Exactly. Delete the message and report the incident to the real IRS.
Because they would never do that.
Nope. John White is constantly educating his clients about these scams, making sure they know how to protect themselves.
It's about empowering people with knowledge so they can spot these red flags.
Absolutely. Knowledge is your best defense.
Well, we've covered a lot of ground in this first part of our tax myth deep dive. But we've got plenty more to unpack, so stay tuned for part 2, where we'll tackle even more misconceptions and arm you with the knowledge to conquer tax season with confidence.
And if you're looking for personalized guidance, don't forget, John White is just a phone call away. He and his team at Financial Guideposts are incredible resources for anyone who wants to get a better handle on their finances. Welcome back to our deep dive into tax myths. We're uncovering all sorts of interesting stuff today.
We are, and I feel like we're just getting warmed up. This next batch of myths is particularly sneaky because they seem logical on the surface.
Oh, absolutely. They play on common assumptions that can lead to costly mistakes if you're not careful.
Like this one. All income is created equal in the eyes of the IRS. It sounds fair, right? A dollar is a dollar.
You would think so. But the reality is that the tax code has its preferences.
It does, doesn't it? It's almost like it plays favorites.
Kind of. The tax code treats different types of income differently. For instance, long-term capital gains from investments you've held for over a year are generally taxed at a lower rate than your regular income.
Oh, interesting. So if you're selling stocks or other assets you've had for a while, that capital gains tax rate is something to keep in mind.
It can make a big difference in your overall tax bill.
This feels like a situation where getting expert advice would be really valuable.
It is. Someone like John White, who understands both the tax code and investment strategies, can help you create a plan to maximize your returns while minimizing your tax liability. He often tells his clients, it's not just about earning money, it's about keeping as much of it as you can.
So true. Work smarter, not harder, right?
Thanks.
Okay, this next myth is especially relevant these days, with so many people working remotely. You can deduct all your home office expenses. Now, I'll admit, when I first started working from home, I thought this was the case.
I think a lot of people do. It seems logical, but the IRS has some specific rules about this.
Okay, like what?
Well, first of all, the space you're claiming as a home office needs to be used exclusively and regularly for your work.
So, not just the corner of the dining room table where you check emails occasionally.
Nope, it needs to be a dedicated workspace.
Got it. And then even if you have a dedicated space, what kind of expenses can you actually deduct?
You can potentially deduct a portion of your rent or mortgage interest, utilities, internet, things like that, but the calculations can get a bit tricky.
Sounds like it. And accurate record keeping is crucial, right?
Oh, absolutely. You need to be able to back up your deductions if the IRS comes calling.
This feels like an area where professional guidance could really save people a lot of headaches.
It really can. John White has a great way of putting it. He says, trying to navigate these deductions on your own can feel like walking through a maze blindfolded. I'm here to be your guide and help you find the right path.
He makes it sound less daunting.
Yeah.
Okay, let's move on to a myth that I think a lot of parents might be wondering about. You can claim your adult children as dependents no matter what. I mean, supporting your kids is a wonderful thing, but I have a feeling the IRS has something to say about this.
They do indeed. The IRS has some very specific rules about who qualifies as a dependent.
So what are the guidelines for adult children?
Generally, to claim an adult child as a dependent, they need to be under a certain age, live with you for more than half the year, and not provide more than half of their own financial support.
Okay, so if your child is over 18, has their own place and a job, you probably can't claim them anymore.
Probably not, but of course there are always exceptions and nuances to the rules.
So if you're not sure, it's always best to check with a professional.
Absolutely, and someone like John White can be a great resource for families trying to navigate these situations. He can help you understand the tax implications and make sure you're doing things by the book while also supporting your children. He emphasizes that there are usually multiple ways to achieve your goals. It's just about finding the approach that works best for you and your family.
It's about getting that personalized guidance that's so important.
Mm-hmm.
Speaking of finding ways to reduce what you owe, let's talk about medical expenses.
Yeah.
There's this myth out there that you can deduct all your medical expenses. I mean, healthcare costs can be a huge burden. Deducting them all would be amazing.
I wish it were that simple, but unfortunately it's not. The IRS has limitations on how much you can actually deduct.
Oh, bummer. So what are the limits?
In 2023, you could only deduct the amount of medical expenses that exceeded 7.5% of your adjusted gross income.
So just to clarify, if my adjusted gross income is $50,000, I can only deduct medical expenses above $3,750.
That's right. And it's essential to keep detailed records of all your medical expenses throughout the year, just in case.
Because you need that documentation to support your deduction, if you get audited right.
Exactly. Doctor visits, prescriptions, hospital stays, even travel costs related to medical care, keep track of it all.
This feels like another area where working with a professional like John White would be a huge help. I can imagine him helping his clients create systems for tracking these expenses all year round.
You're absolutely right. He's all about being proactive and organized, which can make tax time a lot less stressful.
Okay, this next myth is close to my heart because I love giving back to organizations that are doing good work in the world. Charitable donations are always deductible. It would be amazing if this were true, but I have a feeling there's more to it.
There is. While the tax code does offer incentives for charitable giving, there are some rules you need to be aware of.
Like what?
First of all, to claim a deduction for charitable donations, you usually need to itemize your deductions instead of taking the standard deduction.
Okay, that makes sense. And what about the donation itself? Does it have to go to a specific type of organization?
It does. To qualify for the deduction, the donation needs to be made to a qualified organization.
So that cash I slipped into the donation bucket at the bake sale, while generous, might not be deductible.
Probably not, unless that bake sale was organized by a registered nonprofit. You need to make sure the organizations you support are registered as 501c3 nonprofits.
Good to know. I'll have to check on that.
And this is an area where John White can offer valuable guidance. He can help you understand the rules and make sure you're maximizing your charitable giving while staying compliant.
It's like combining generosity with smart financial planning. Okay, this next myth might sound tempting to those just starting out in their careers or with limited income. You don't need to file a tax return if your income is below a certain threshold. It was certainly my thought process when I first graduated college.
I think a lot of people assume this, but the reality is that the filing requirements can be a bit more nuanced.
In what way?
They depend on a few factors. your age, filing status, and the types of income you have. Even if your income is below the standard deduction threshold, you might still need to file.
Okay. What would be an example of that?
For instance, if you had taxes withheld from your paycheck, you might be eligible for a refund even if you don't owe any taxes.
So you could actually get money back.
Exactly. And there are certain credits, like the earned income tax credit, that are available. It can be. So even if you think you don't need to file, it's always wise to check.
It's better to be safe than sorry. And speaking of being safe, let's debunk this doozy. You can just estimate your taxes and not worry about keeping detailed records. As someone who's not exactly the most organized person, I can see how this would be tempting, but I have a feeling it's a recipe for disaster.
It's a recipe for an audit, that's for sure. The IRS takes record keeping very seriously.
Okay, so why is it so important?
Well, accurate records ensure that you're reporting all of your income and claiming deductions accurately. It makes tax preparation much smoother, and it protects you if the IRS ever decides to take a closer look at your return.
So you're covered if they come knocking.
Exactly. John White is really big on proactive record keeping, and he helps his clients set up systems that work for their lives, whether that's using spreadsheets, accounting software, or good old-fashioned folders and file cabinets.
It's about finding what works for you.
Exactly. He tailors his guidance to meet his clients' needs and comfort levels.
Okay, this next myth is one I've heard debated a lot.
Yeah.
It's better to owe taxes than to get a refund?
Mm-hmm.
The logic being that, hey, at least you had access to that money all year long. But is that really the best strategy?
It's a common misconception. Remember, a tax refund is just the government returning the money that you overpaid throughout the year. It's not free money. It's your money that you could have been using for other things.
Like investing, paying off debt, or just having more financial flexibility.
Exactly. John White often compares it to giving the government an interest-free loan.
It's a good way to think about it.
He encourages his clients to adjust their withholdings or estimated payments to avoid overpaying in the first place. It's about optimizing your cash flow and making your money work for you.
Smart move. Now, here's a myth that I think we all wish were true. Tax laws never change, so I can just do my taxes the same way every year. If only life were that simple.
I know, right? Unfortunately, the tax code is constantly evolving.
It's like trying to hit a moving target.
Exactly. New laws, regulations, and interpretations are always popping up. Trying to keep up on your own can be a full-time job.
I can only imagine this is another area where having an expert like John White on your side would be so helpful.
Absolutely. He stays up to date on all the latest changes and can advise you on how they might impact your specific situation.
So he's like your tax code translator, helping you make sense of all the jargon and legalese.
That's a great way to put it. He breaks things down in a way that's easy to understand.
We love that. All right, let's wrap up this section with a myth that I think a lot of people gravel with. Doing your own taxes is easy, so why pay someone else to do it? And while there are certainly resources out there for DIY filers, the truth is that taxes can get complicated pretty quickly.
They really can, especially if you have multiple income streams, investments, own property, or have other factors that complicate your situation.
It's not just filling in a few boxes on a form anymore.
And making mistakes can lead to penalties, audits, or missed opportunities for deductions and credits. Sometimes that peace of mind that comes with having a professional handle things is worth every penny.
I can definitely see that.
John White often tells his clients, your time and energy are valuable. If you're feeling overwhelmed or unsure about your taxes, it's okay to delegate to a professional who can do it accurately and efficiently.
He's all about helping people focus on what they do best and letting the experts handle the rest.
Exactly. It's about teamwork.
And we're back for the final stretch of our deep dive into tax myths.
We've saved some of the trickiest ones for last.
We have, haven't we? Ones that can have some pretty big implications for your overall financial picture.
Exactly, especially when we're talking about major life events or long-term planning.
Okay, so let's jump right in. This next one caught my attention. Your state of residence doesn't affect your federal taxes.
It's a common one for sure. We all know states have their own taxes.
Right, but do those state taxes somehow impact what we owe to the federal government?
Well, it's not a direct connection, but your state of residence can indirectly affect your federal tax liability.
How so?
For example, some states have deductions or credits that can actually reduce your federal taxable income.
Oh, interesting. So it's like a domino effect.
Kind of. And then there are the state and local tax deductions, or SALT deductions, as they're often called.
Right, I've heard about those.
The limits on those SALT deductions can really impact people who live in high tax states.
So it's worth paying attention to how your state's tax policies might influence your federal taxes.
It really is. And it's another area where someone like John White can be incredibly helpful. He understands the interplay between state and federal tax laws inside and out.
Right, he's like a walking encyclopedia of tax knowledge.
He can help you navigate those complexities, whether you're thinking about relocating or just trying to optimize your current situation.
Speaking of optimizing, let's talk about another myth that I think holds a lot of people back. Tax planning is only for the wealthy.
Ah, yes, the I'm not rich enough to worry about that mentality.
Exactly, like my finances aren't complicated enough for fancy tax strategies.
But the truth is that tax planning can benefit people at every income level.
It's not just for the super rich.
Nope. It's really about being proactive and making informed decisions throughout the year, not just scrambling at the last minute come tax
It's
season.
like the old saying, an ounce of prevention is worth a pound of cure.
Exactly. John White often tells his clients, tax planning isn't about finding loopholes or cheating the system. It's about taking advantage of legitimate strategies to minimize your tax liability and maximize your financial well-being.
I love that. It's about being smart with your money, no matter how much you have.
Absolutely.
Okay, this next myth is something I've definitely wondered about before. You can't change your tax withholding once you set it. So if you make a mistake at the beginning of the year, you're just stuck with it.
Thankfully, no, you actually have quite a bit of flexibility when it comes to your withholding.
Oh, good.
Life happens, things change, incomes fluctuate, and sometimes you just need to make adjustments to make sure you're withholding the right amount.
So if you get a raise or start a side gig or have a major life event, it's smart to revisit your withholding.
Absolutely. Make sure it aligns with your current situation. And it's a pretty easy process to adjust.
And this is another area where John White can be a great resource, right?
Yeah, definitely. He can help you calculate the ideal withholding amount, explain how to make adjustments, and make sure you're on track to avoid any surprises at tax time.
I can imagine those surprises being pretty unpleasant.
He'd rather see his clients get a little bit back each month rather than owing a big chunk all at once.
Or getting a huge refund and realizing you've essentially given the government an interest-free loan.
Right.
Okay, I think this next myth speaks to our desire for easy solutions. Tax preparation software is all you need to file your taxes correctly.
Those ads make it seem so simple, don't they?
Just plug in your numbers and you're good to go.
While tax software can definitely be a helpful tool, especially for people with relatively simple tax situations, it's important to remember that it's not a magic bullet.
So it can't solve every tax problem.
Not exactly. These programs can't offer personalized advice, interpret complex tax laws, or represent you in case of an audit.
So there are some limitations.
There are. And if you have a more complex financial situation, like self-employment income, investments, or own a property, seeking guidance from a professional might be a good idea.
Makes sense.
John White often compares tax software to a GPS. He says, it can get you from point A to point B, but it can't tell you about road closures, traffic jams, or scenic detours.
I love that analogy. It's like having that expert navigator to help you avoid those potential pitfalls.
Exactly.
All right, let's wrap things up with one final myth, and I think it's one that a lot of people feel deep down. Paying taxes is just a necessary evil. There's no way to make it work for you.
Yeah, it's so easy to feel that way, isn't it?
It is. It's like, there goes a big chunk of my hard-earned money, and I have no control over it.
But that's where I think a lot of people miss the opportunity.
What do you mean?
While we can't avoid paying taxes altogether, we can certainly approach them in a way that benefits us.
Okay, so how do we shift our mindset from necessary evil to something more positive?
It starts with understanding how the tax code works and then utilizing the various deductions, credits, and strategies that are available to legally minimize your tax liability.
So it's about being proactive, being informed, and taking advantage of the tools that are out there.
Exactly. Making informed choices about investments, retirement savings, and charitable giving.
And potentially structuring your income and expenses in a way that's tax efficient.
That's right. And this is where John White really shines. He doesn't just prepare tax returns. He helps people develop comprehensive financial plans that incorporate tax considerations into every decision. He often tells his clients, taxes are just one piece of the puzzle. It's about putting all the pieces together to create a picture of financial well-being.
That's such a great way to put it. It's about seeing the bigger picture and making choices that benefit you in the long run.
Exactly.
So even if you're feeling overwhelmed by the complexity of taxes, remember, you don't have to go it alone. There are experts like John White who can guide you and help you make sense of it all.
Absolutely. And that's the beauty of having a trusted advisor in your corner.
And on that note, we're wrapping up our deep dive into tax myths. We've covered so much ground today, and I hope you're feeling empowered to take a more proactive approach to your taxes.
Remember, knowledge is power, especially when it comes to your finances.
So true. And if you're ready to take control of your financial future and get personalized guidance, don't hesitate to reach out to John White and his amazing team at Financial Guideposts. They're a wealth of knowledge and genuinely dedicated to helping people thrive. Thanks for joining us on The Deep Dive.